All right, we're going to pick up on learning objective 11.3, and we're going to do 11.3 and 11.4 in this video. Okay, for this first one is accounting for liabilities that are to be estimated. Remember, I kind of uh, made a point on that first one about known liabilities. These are ones we don't really know how much. We know there's a liability, but we don't know how much. Okay. So some of the examples would be bonus plans, vacation pay, health and pension expense benefits, and warranties. Warranties is probably a really big one because, if you buy a car, you might get 3 years, 36,000 miles, or, I think Hyundai actually does warranties up to 100,000 miles. So warranties are a big deal. And the reason we have to estimate these is because we're trying to match that expense with the revenue. So if you think about a car, we're trying to match the warranty expense with the sales of the car in that particular year. Okay. Is it going to be a perfect estimate? No. Will it be better than nothing? Yes. Okay. So the first one they talk about is a bonus plan. And they say that they estimate that it'll pay a 5% bonus on the annual net income after deducting the bonus. So this is a little bit more complicated because of that after deducting the bonus. So we have the bonus percentage multiplied times the net income. Then we're going to divide that by 1.05, and that would leave us with $15,000. Okay. So we're assuming that Smart Touch Learning will not make a payment until the end of next year, but it does have to record the liability. Okay. So they would debit employee bonus expense and credit employee bonus payable. Okay. We can have pension benefits. Here they're going through an example on vacation benefits, and you might earn vacation days. A lot of businesses will do this a lot different. They might like for every hour you work or every 8 hours, you get a certain percentage of your vacation. Okay. They'll do it like that. Some of them will just say, hey, we're just going to dump it all in your account. You can take it all whenever you want. Okay. Businesses just have different ways of different things. Probably not going to find consistency across different industries on that. I know being a professor, I get 3 personal days a semester. Yes, I get the whole summer off, so I try to do as much stuff, take care of as much stuff as I can in the summer when I'm off. I sometimes feel like I'm running a marathon in the summer, but like I think it's a good thing that we can't take a week off and go to Disney World in the middle of the semester because that would be very hard on the students. So we do only get 3 personal days. We do have more sick days, and those accumulate at a different rate because you really can't help when you're sick. Okay. So they have vacation benefits. We are debiting the expense and crediting the payable. Okay. Warranties. So a lot of companies have guarantees or warranties. There's usually a time period on the warranties. So I mentioned the matching principle is the reason why we want to estimate our warranty expense. Okay. So here they give us an example. Smart Touch Learning made sales on account of $50,000. Cost of the merchandise inventory sold 35,000. Don't forget, when you sell inventory, you've got to make those 2 journal entries, okay? So the very first one is to debit the accounts receivable, credit the sales revenue. Then we are going to debit cost of goods sold, credit merchandise inventory. Okay. So then they tell us that this is subject to a 3% of sales warranty. Okay. So 3% of the sales, 50,000 multiplied times 3%. I'm sure they've already done the math for us. I did not do it off to the side. So they tell us that some of Smart Touch Learning's customers make claims that must be honored through the warranty offered by the company. The warranty cost, whoop, I did not record. I skipped over recording it. Sorry about that. I'm missing that one right there. That's why I was like, whoop, something's wrong. So we estimated 3% of sales to be 1,500. Again, not a perfect number, better than nothing though. Okay. We will debit the warranty expense and credit estimated warranty payable. Okay. So we now have a liability out there, warranty payable with a credit of 1,500. Okay. Then they tell us some of Smart Touch Learning's customers make claims that must be honored through the warranty offered by the company. The warranty cost totaled 800 and are made on June the 27th. The company replaces the defective goods and makes the following journal entry. Okay. We are going to debit that warranty payable for 800 because remember we've already came up with an estimate. It's kind of like that accounts receivable and bad debts. Like we don't know who's not going to pay their bill. We just know a certain percentage will not pay their bill. Again, we probably, whatever this item was, we probably wouldn't have sold it if we known it was defective. Okay. But we don't know that. It's just an estimate. Okay. But now we know and we have to pay for that. So we will debit the warranty payable and credit merchandise inventory. Notice how that brings this warranty payable down to $700. Okay. The next learning objective we're going to talk about is 11.4, and we're looking at contingent liabilities. Contingent liabilities, these are dependent upon some other event taking place. I usually think of a lawsuit. If a company gets sued, a lot of times companies will settle just so they won't make too much noise. Okay. That aggravates me when people do that. I think of frivolous lawsuits. Okay. Things that it's probably so minor, we're probably not going to lose money. Okay. But then there's some bigger ones. Like, I know it's been over 20 plus years, Bridgestone Firestone had put a certain tire on Ford Explorers, and Ford Explorers tires would blow out, the cars would wreck, and a lot of people died because the tires they were putting on these cars had sat in the warehouse too long. They still looked good, but they were pretty much dry rotted. That was huge. That was a huge, huge liability. And they made it through it, but they had lots and lots of contingent liabilities that they had to pay out. Okay. Um, when you think of them, they have to fit in these categories. This is more of legal terms, has to fit into one of these three categories. We can't say reasonably probable, reasonably remote. We can't say anything like that. It has to be remote, reasonably possible, and probable. Okay. Depending on which one it is how we're going to account for it. Okay. So the first one, this remote, we're not going to disclose it. It's a frivolous lawsuit. Nothing's going to come out of it. We don't have to tell anybody. We don't have to disclose it. We don't have to make a journal entry. It's probably not going to happen. Okay. If it's reasonably possible, then all we're going to do is make a note. Okay. A note in the financial statements. We're not going to make a journal entry though. Okay. If it's probable and the amount cannot be estimated, we are again just going to make a note in the financial statements. Okay. If it's probable and we can estimate that loss really good, we're going to make a note and a journal entry. Okay. We're going to do both. We're going to go ahead and provide for that contingent loss. Okay. And that is all for chapter 11. And we will stop there and I will see you again in the next chapter.